Hey everybody, welcome back to the channel. Hope you guys have been doing well. In today's video, we're going to begin by going over a little bit of macro. I'm going to give you guys my views on what I expect to happen in the coming months. And I'll end the video by updating you guys on the progress I've made on Sharky.fi. It's basically a platform that allows NFT holders on Solana to use their NFTs as collateral in order to satisfy their short-term liquidity needs. And individuals who are lending to these NFT holders are rewarded with fat yield and yield farming rewards. As I explained in my previous video, I decided to take a little bit of my own money and experiment with the platform, which is currently in beta. So in this video, I'll give you guys a brief overview. I'll show you guys how much I've made, and I'll give you the pros and cons of using such a platform to accumulate SOL during this bear market. And if you guys haven't joined my Discord already, I'd recommend that you guys do. The link is in the description below. The long-term plan is to basically turn it into an alpha hub, a place where like-minded individuals can organize and share quality alpha that could help us kill it in the next bull market. Again, if you guys are interested in joining a community like that, the link is in the description below. With that being said, let's go ahead and dive into this video. All right, to get things started, I want you guys to go ahead and listen to this clip from CNBC. The guest on the show outlines why he's bullish for the coming months. And the reason I wanted to highlight these points is because I don't think he's the only one that holds this view. And if that's the case, I think there's a reasonable chance that we enter a brief risk on period.
Piggyback off of your prior guess, I do believe that the Fed may and will actually raise rates by only 50 basis points after their December meeting. In other words, slow down the increments of which they're going to be raising interest rates. Why is that important? Well, it will signal to the market that perhaps we've now reached peak hawkishness and by extension, peak inflation. And going back to 1927, Dom, history shows that stocks rise on average 11.5% per year in the year following peak inflation. Now, when I say that, Dom, I don't want you to misconstrue that to suggest that I believe that inflation is going away overnight. It's not. I'm not suggesting that the Fed's going to stop raising interest rates. They're not. I'm also not suggesting that these short-term bouts of volatility are behind us, because they're not. But if the Fed slows down the increments of their interest rate hikes, that will signal that perhaps the worst is behind us with respect to the magnitude of these interest rate hikes. And then, of course, there's the midterm elections. And that's the second potential tailwind that we see, Dom.
Why a tailwind? Is it just a seasonal factor? Midterms are just generally good years, so you have this idea that valuations are already depressed and that you get a seasonal kind of tailwind in what's happening with the midterms, and that's why you feel so good about things?
Yes and yes. So going back over the last 60 years, stocks have risen on average 16.5% per year in the 12 months following midterm elections. That outperformance is even more pronounced in the 3 and 6 months following midterm elections. We also know that generally a divided government bodes well for the stock market. And it appears right now, if the polls are correct, that we will have a divided government coming out of these midterm elections. So the outcomes of the midterms and the Fed turning slightly less aggressive with respect to the pace of their interest rate hikes are two tailwinds that could lift stocks higher.
All right. And by the way, lifting stocks higher is a tough task now because the sentiment seems to be downright negative. And we just want to call your attention right now, viewers and listeners, right now to the fact that the Dow has just now drifted into negative territory, albeit so slightly. So again, losing some momentum right now.
Now, outside of a pivot, I think the best thing the bulls are going to get is either a slowdown or a cessation of rate hikes. And if that happens, there's a good chance that the market's going to react favorably to that. But in my view, I think they're going to act a little bit prematurely because once the rate hikes slow down, you want to wait to see what kind of impact that has on the broader economy. Because there's still a debate going on whether we're going to have a shallow recession or if we're going to have a deep recession. So if you're on the camp that we're going to have a shallow recession, I could understand you going in a little bit early. But if you're unsure, to me, it doesn't make sense to buy unless you're planning to trade the rally. And I'm sure a lot of these analysts for hedge funds are looking at past data. And based on that past data, post midterms, the markets tend to do pretty well. So if you have a decent amount of funds out there playing that trade, that's another reason why you could see a brief risk on period. And lastly, the sentiment is very negative. If you look at the biggest rallies we've had, they've come out of huge pullbacks. And currently there's heavy short interest amongst retail investors. And my guess is the market isn't going to make another big leg down until the short interest decreases substantially. Also, aside from everything that I've just covered, the charts are also suggesting that a brief risk on period might be coming. If you take a look at the yields after making this strong run here, they look like they might be ready to enter consolidation. And the same applies to the dollar index. If you look at every strong rally, it's been preceded by a sell-off. And after the sell-off, you have this acute consolidation period, after which we see another big move up. And I think we're in that consolidation period again. And my expectation is that once this consolidation period ends, we're going to continue our ascent up. And I think we're going to cross 120. Personally, I feel like the dollar has some legs to go. I think a lot of wealthy people outside the United States that have access to our capital markets are probably going to seek sanctuary in the safety of the dollar until they feel safe to go back to other currencies. Another chart I suggest you guys keep an eye on is the high yield bond ETF. This here is a key area. It's acted like support over the last few months, but it looks like we might be seeing an SR flip here. If that's the case, in my view, it increases the odds of another big leg down. And if you follow me on Twitter or YouTube, you know that I like to use these indicators to help project which direction the market's going. I mean, the last time I used these indicators, I did pretty well in calling the local top. Now, I don't expect a 100% hit rate with these, but I think they add a lot of useful confluence. And when you have a decent amount of confluence, you feel a lot more confident when you enter a position. And for those of you guys who are interested in using these indicators, generally speaking, when you see JNK going down, you see the VIX going up, you see the yields going up, and you see the dollar index going up, that usually means that the market is likely to trend lower. And these indicators won't begin those moves up simultaneously. Typically what you'll see is the yields lead, and sometimes days to weeks later, you might see the other indicators also begin to make their bearish pivots. In the context of equity markets, again, that means the yields going up, the dollar index going up, the VIX going up, and junk bonds going down. And to add even further confluence to that, what I like to do is gauge the general sentiment on CT, FinTwit. I'll take a look at the net interest in shorts versus longs. And lastly, I'll see how the market reacts to positive or negative news. For example, if the markets don't dump on negative news, or they dump very little, and on positive news, they tend to rally very strong, anecdotally speaking, there's a very strong chance that the markets are going to rally a lot higher. All right, in the previous video, I told you guys that I'm going to be lending here on Sharky.fi in order to accumulate more SOL during the bear market. And to date, I've made 18.56 SOL in profit, which equates to $543 based on the price of SOL today. Now, this might not seem like much, but you have to remember, SOL in the future, if it ever reclaims its previous highs, the 543 that you see here would be approximately $4,500. And the profits I'm making are going to be compounded. I'm going to be able to lend out more SOL to earn even more SOL. And you can look at the yields here. These yields are not annualized yields. This is the yield that I made in a 7-day period. And I did have some cases where we had individuals default on loans. For example, here on Utes, I gave a loan of 107. Someone defaulted because at that time Utes were worth less than 107. I think they hit a bottom of approximately 85 SOL before bouncing and pushing past 110. So I decided to sell one of them for 110, and I ended up netting 3 SOL off of that. Now I also had other defaults as well. If you look at the Vandal loans that I gave out here, I gave out 6 SOL per Vandal. They were defaulted on, and I was able to sell them on the secondary market for 6.49. And this ended up working a lot better for me because if they ended up paying back the loan, I would have made about 2% in a week. But since they didn't pay it back, I was able to make approximately 10% in a week. And some of my bigger loans that were successful, like the SMB holder that I lent to, this was a 14-day loan. I got back 6.35. And so in 2 weeks, I made almost 4%. Now, I do want to emphasize there's a strong possibility that SOL might make another new low for the year. I mean, some traders out there are projecting between $10 to $20. If that's the case, you might be accumulating more and more SOL, but short term, while the price of SOL remains relatively low, you're technically at a loss because the value of SOL has gone down so much. But again, like I stated in a previous video, I'm okay with that because my plan is to use a small portion of my portfolio to accumulate more SOL and compound those gains. Now, let's say you wanted to follow in my footstep and also give out loans to NFT holders that are using their NFTs as collateral to get short-term liquidity. You come here to the lend page, and let's say you wanted to lend to a UTS holder. You click here on lend, enter the amount that you're willing to lend them, the number of offers you want to put out there, and then place offer. After that, you basically have to wait for somebody to come in and accept your terms. So that means they're willing to pay 240% APY on a loan with a duration of 7 days. And like you, there's other people out there that are willing to put out offers. So if you want the offer to get accepted relatively quickly, and you can see here that a loan's basically taken out every 4 hours, which means there's a decent amount of demand from borrowers, which probably has a lot to do with why the APY for this collection is a lot higher than the other collections. And there's actually two benefits for being one of the higher offers. Number one, it obviously increases the odds of a borrower selecting your offer. And secondly, since it's a larger amount of money, you're also going to earn more SOL. Because for example, a 2% interest on a 100 SOL loan is going to yield more than, let's say, a 2% yield on a 90 SOL loan. But on the other hand, if your offer is too high and it's pretty close to the floor price, and the floor price happens to move in the opposite direction, then there's a very strong likelihood that the borrower is going to end up defaulting. Because if they borrow 101 SOL and now the floor is worth 90 SOL, from their perspective, it makes more sense to default on the loan because now they can get another UTS NFT at a discount. I mean, there's other variables you have to take into consideration too, because if, let's say, for example, you were to loan out to somebody who holds a DGODS, maybe they have a rare DGODS that's worth 2 to 3x of what the floor price is. In that case, the borrower is more likely to pay back the loan than default. Now, what I would recommend before you guys get started is to do your own due diligence, research all of these projects, because ideally you want to lend to collections that you wouldn't mind holding in the event of a default. And so for me, that means lending to UTS, DGODS, Blacksmith, Solana Monkey Business, ABC. And outside of that, for smaller loans, I'd suggest going down here to Vandals, because as you can see here, the volume is pretty decent. So there's a good chance that someone is going to accept your loan conditions. And secondly, if you look at the floor price, it's at 6.6. There's pretty good support here at 6. So you have some buffer here in the event of a default. And like I showed you guys on my Excel sheet, the defaults ended up working in my favor because I ended up making more money by selling it on the secondary market than I would have made if they had paid back the interest. And aside from picking a collection that you wouldn't mind holding, you also want to make sure the collection that you're lending to has a decent amount of money, because you don't want your offer to sit out there for days on ends. You want to make sure that the offer gets accepted as soon as possible. And so that's going to require you guys to stay on top of things. I'd suggest checking in every day or two to see if your loan has been accepted. I'm personally using a ledger, and for that reason, I'm not able to use notifications, but this feature here works just fine with hot wallets. So if you're not using a large sum of money, I'd probably recommend using a hot wallet to interact with this platform. That way you don't have to spend too much time logging in and out. You'll just be notified via text or email when somebody has accepted your loan conditions or when somebody has defaulted or paid back their loan. Now, this video is intended to be comprehensive, so I'm not going to go over all my strategy and insights in this video. If you guys are interested in learning more before I publish my comprehensive review, definitely check out my Discord and ask questions there. But lastly, I wanted to end with saying that currently they have this Sharky rewards point system that basically allows you to earn their governance token before it's released. So for every 10 points you earn, you can redeem one fishy token in the future. The reason I'm personally very excited about this is because there were a lot of big names that participated in their last raise. And on top of that, out of all the NFT lending and borrowing platforms out there, Sharky.fi has the most interest in volume. And after they turn on the fees, token holders and NFT holders are going to be able to share in the revenue that they collect. And if that ends up happening, that's another $1,000 that I'll make on top of all the yield that I'm earning. And so for that reason, I'm very excited to be accumulating Sharky tokens because these tokens could easily be worth 10 cents. And for those of you guys who've stayed until the very end of this video, I wanted you guys to know that I'm working on an Excel sheet that I'm open to sharing with the public. If any of you guys are interested in using this sheet, make sure to reach out to me. I'll share it with you once it's completed. With that being said, I hope you guys enjoyed today's video. This is CryptoOneStop signing out. I'll talk to you folks next time. Bye.